All right, good day and welcome to all. What I'd like to do is ask anybody that has questions for Paul or myself, please forward the questions via the questions tab on this webinar control box. Uh, and this session will be recorded. And I just want to tell you that CAMA does not endorse or recommend any investments, products, speakers, opinions, etc., and always request that you coordinate with your trusted professionals before making any investments. So today I'd like to welcome Paul. Like myself, he graduated in engineering and went on to get his MBA and then worked for Ford Company, where I worked for Martin Marietta. He also owned a staffing company and then entered into the real estate arena after selling the staffing company. He completed 85 real estate investments and exits from those investments. Unlike myself, I pretty much am a buy and hold real estate investor. He was also featured on HGTV in the real estate version or episode. He developed waterfront subdivisions and started 2 real estate marketing firms. He's an accomplished author of The Perfect Investment. Paul, I hope you'll be at the Mid-Atlantic Summit in October 2019 in Philadelphia, where you can meet and talk to him. So he'll let us know if he's going to be there at that point in time. Are you, Paul, going to be there?
Absolutely. Right, I can't wait.
All right, so our audience can actually meet you if they show up to that. All right, so I want to welcome you today and ask you to tell us about the 2 overlooked real estate assets killing it everywhere. We had our last webinar a little bit over 6 weeks ago, and that's posted and on the website, and I appreciate you agreeing to do a series of these and sharing your wisdom with us. So take it away if you don't mind.
Hey, Carl, I blew it. I was going to have this big drum roll thing and roll out these 2 investments that are killing it everywhere all the time, but I put them in my cover slide. What was I thinking? So anyway, it's great to be here. Thank you for the opportunity. I'm really honored to be with CamaPlan and be a guest again on your on this webinar series. So again, I'm Paul Moore. I'm founder and managing director of Wellings Capital. It's not Wellington. Those are the guys that make billions of dollars a month. But Wellings Capital, I'm a serial entrepreneur. Spent years chasing shiny objects. I've done all kinds of things. I've done about a dozen different things in real estate investing, which has been a lot of fun. Sometimes they've been profitable. Sometimes they've been very unprofitable. I've got a podcast on iTunes called How to Lose Money. It's actually a wealth building podcast. Carl, you should be a guest, but then again, maybe you've never lost money in anything. But our guests tell us their failures, their pain, their mistakes, and on how they learned a lot from these things on their road to becoming successful. So, and I will be in the Philadelphia event. So I've written 2 real estate books. I'm actually working on a 3rd one right now. The second one is called The Perfect Investment, and it's about multifamily housing. And this book is a strong defense of why multifamily investing is the perfect balance of risk, return, stability. It has amazing demographics, long-term future. If I was going to invest in anything, if I had to put $1 million in one asset class and leave it there for 100 years, it would be multifamily. I love multifamily, but right now I'm not investing in multifamily real estate. I still want to. I'm looking for deals. I've been a multifamily syndicator for a number of years, but recently Wellings Capital has expanded and we've opened 2 different funds, a Wellings Growth Fund and a Wellings Income Fund. And our desire is to capitalize on assets that might fare better than others during the potential coming downturn. We don't know when a downturn will be. We do know that this is the longest expansionary period in the history of the U.S. At least it will be in 5 more months by July of 2019. So, as you already know from my cover slide, we've expanded into self-storage and manufactured housing communities, also known as mobile home parks. And we are really excited about this. And I'm going to tell you today why these areas that are not super sexy, not super exciting, don't seem like they have a lot of value add, actually really do. But before I get into that, I want to talk about this man, Jeff Bezos. Now, Jeff, as you know, is the founder of Amazon, and I believe he's still the richest man on the planet, or at least in America right now. And Jeff did a really weird thing a couple of years ago. Jeff went around all their facilities and he took the light bulbs out of the vending machines. Now, Carl, why would somebody do that? Why would somebody take the light bulbs out of the vending machines in all the Amazon facilities?
I got no idea.
It's crazy, isn't it? Well, why? You might wonder why, but Amazon is known for taking great pains to be very cost conscious. And so Jeff reasoned, hey, these light bulbs cost money. The electricity to power these light bulbs costs money. And the maintenance to replace the light bulbs costs money. Why bother with spending that money when all we're doing here is advertising, Lance snacks or whatever, Nabisco. And so he reasoned that they didn't need lights in them and he took them out. Now, Jeff knows something, and that is this, that there's a price to earnings ratio, a PE ratio in stocks, and Amazon's PE ratio means that every dollar they can add to their bottom line is going to be multiplied in value at the level of Amazon's stock price and therefore Jeff's wealth. So let's say he can save $1 a month. And if you can do that, that's $12 a year, but at a 20-to-1 PE ratio, by the way, I have no idea what Amazon's price to earnings ratio is, but at 21, that's $240 value added to Amazon's wealth, Amazon's value. Well, commercial real estate is similar. And today I want to talk briefly about an overview of why a lot of single family investors and other investors have turned to commercial real estate to increase their income and magnify or multiply their wealth. A lot of the Forbes 400 has made their money in commercial real estate, and a lot of them have made it in tech, but they're investing in commercial real estate to continue to multiply their income. So let's talk about a dollar again. So if you can add $1 to your bottom line in commercial real estate, let's say you can add $1 to the revenue or cut $1 of cost, you're adding a dollar in income. Now, Carl, I was really good in math because I was an engineer like you, and I can tell you that $1 a month is $12 annually. Pretty good, huh? And that $12 annually, now in single family, let's say you're Chip and Joanna Gaines Jr., and you can fix up your house in the western suburbs of Philadelphia to be the most beautiful house on the block. Let's say you put $700,000 into it. You stage it beautifully, you get it really perfect, but every other house on your block is selling for $450,000 or less. You're probably not going to get that $700,000 for your house, even if you put into it, because the value is limited because of the comps, the comparable properties. And most of us understand this. In commercial real estate, the formula is very different. The value formula for commercial real estate is value equals net operating income divided by the cap rate. So the net operating income is the not counting the debt service, it's just the net income produced by operations. And then the cap rate, the denominator in that formula, is the capitalization rate, or the ongoing expected rate of return for that type of asset in that geography at that time. Okay, so that's called the cap rate, and those typically run from between 4 and 10%, let's say, okay? So if you can, remember, the value is the net income divided by the cap rate. So if you can expand the numerator, and that's income, you can increase your value. If you can compress the denominator, that's the cap rate, you can increase your value. And if you can do both, you can really multiply the value of your asset in commercial real estate. So it's not limited by comps like residential. So back to our example, you've got $1 added to the bottom line per month, that's $12 per year. You divided that by a 6% cap rate, And that $1 adds $200 to the asset value. It's pretty amazing, isn't it? But it's even better than that, because commercial real estate investors typically, syndicators typically use debt. They have leverage involved. So if you have a 60% LTV, 60% loan to value debt, then you're actually multiplying the impact of that $200, that $1 in income that became $200 in value. If you have 60% loan to value debt, that's 2.5 times the impact on the equity. And if you want to do the math on that, it's $200 divided by 1 minus 0.6. In other words, the LTV. So we can talk more about that later if you have questions. So the power of a dollar in commercial real estate is very, very powerful. Now, in self-storage or mobile home parks, which we're going to talk about in a minute, let's talk about how you could create a dollar. I was pretty skeptical about, I can see the value add potential of apartments. You can put in new flooring, new lighting, new sinks, countertops, cabinets. You can paint, put in nice accent colors. How do you create value add in, a trailer park? Or how do you create value add in a self-storage facility? My goodness, it's just 4 pieces of sheet metal, rivets, and a concrete floor. There's lots of ways to create value. So here's a few quick examples. Let's say you could fill 15 vacant lots in a mobile home park community at $350 a space, times 12 months, times 15. Okay, that's a lot of income added. Divide that by the cap rate and you just create a lot of value. Or let's say you can save $25 per client per month on water bills by passing the water bill back to the clients, the tenants. Let's say there's 300 spaces, $25 a month times 12 months. That's a lot of value you could create if you can acquire from a mom and pop and make this change. And by the way, that's a very, very typical change when acquiring a mobile home park community. Or let's say you can raise the lot rent by 5%. That's perhaps $15 a month. Multiply that by 300 spaces. Negotiate a cable or internet deal for $20 a month. Spend $100,000. Now I'm going to tell you a story where Wellings Capital is investing with an operator right now that just paved an acre of weeds. Now, why would they pave an acre of weeds? Well, Carl, they put a fence up and they paved this 1 acre, and they're saying, hey, a lot of you guys have 3 or 4 cars, and some of them are junk cars. You need to move any car above 2 over into this paid parking area. By the way, we're going to charge you for that. And if you have an RV, if you have a boat, if you have anything else like that, you have to put it in this paid parking area. He spent $100,000 to do this. And when it's full, when it's absolutely full, he's going to be charging up to $10,000 a month. I put 9,000 as an example here. So he's going to have about 100% annual ROI on that 100,000 he spent when he's full. But more powerfully, think about this: $100,000 a year. I think it's actually $120,000 a year. You divide that, that's the income. Divide that by about a 6% cap rate, and I believe that creates about $2 million in additional value. Now let's say he paid $5 million for this mobile home park. And let's say he created, he had a 60% loan to value ratio on that. So he had $3 million in debt, $2 million in equity. He just added $2 million in value. So he took the equity value from $2 million to $4 million with this $100,000 change. That's a real example, folks. Now, it's not done yet because he hasn't got it all leased up. And furthermore, he doesn't know if he'll be able to sell it for a 6% cap rate. And he doesn't, there's a lot of unknowns. But that's the kind of power that exists in commercial real estate. And so what I wanted to do, Carl, was take a few minutes before we got into this, just to take us through why investors and operators and other real estate people are turning to commercial real estate. And I tell you, if I told my son this, I told my team this, if I would have known the power of commercial real estate years ago, I never would have done residential or anything else. This is what I would have done. So here's a couple more examples. At a self-storage facility, you can add U-Haul, and you can add up 1,000 to 4,000 a month in commissions. I had 2,000 as an example. You can sell boxes, locks, tape, and scissors, and you can maybe add $1,000 a month. That's $12,000 a year. And again, that's $240,000, I think, in value you add to the facilities. You can add insurance. You can add late fees. Multiply that times 800 storage units at $5 a month. It's great for income. It's even better for value. So why is this multifamily author not investing in multifamily at the moment? Again, I love it. The demographics and the long-term outlook are strong. The problem is, as many of you know, multifamily is significantly overheated right now. Multifamily is, the world is running after multifamily. It's cool. It's exciting. There's dozens of books out about multifamily. There's lots and lots of podcasts. There's all kinds of training and articles and all kinds of things. The default rate was almost zero through the last recession. And rumor has it, my friend Dave Stevens is the head of the Mortgage Bankers Association. I haven't asked him personally, but I've heard that with Freddie Mac and Fannie Mae, there's zero defaults in large-scale multifamily for the last 4 years. Wow, that's pretty cool. But like I said, the cap rates are very, very low right now, which means the pricing is very, very high. It's very hard to get a good deal. And I'm worried that maybe the space is overheated. Maybe this is the new normal, folks, and maybe that's just how it's going to be. Maybe we need to expect, 4, 5, 6% cash on cash returns for a long time rather than 10. But the space is no doubt overheated. And why? Well, there's a lot of you investing in it. A lot of people like me investing in it. There's a lot of IRA investors, which is great. There's a record number of self-directed IRA and 401k investors investing in real estate right now. There's also a record amount of 1031 exchange money coming into the space. There's a record amount of international and institutional money running at it. It used to be the institutions like REITs and life insurance companies were in the big major gateway cities, but now they're coming in from the coast like New York, LA, San Francisco. They're coming into places like Lexington, Kentucky, and Kansas City and Tulsa, and they're investing, they're competing, driving the prices up because they don't need as high of a return. There's also something I call the Nuru impact, and it's a term I'm trying to coin, Carl, but it's not taken off yet. Maybe this group can help me. It's basically new gurus, people who weren't really in real estate 10 or 11 years ago during the recession, but now they're considering themselves gurus, and they're telling everybody that it's okay to overpay. I was actually at a big seminar with hundreds of people, and a very famous a multifamily syndicator took the stage unexpectedly in December, and he got up, and I was actually delighted to see him, and he said, hey, it's okay to overpay for multifamily. Just get in and hang on. It'll turn out all right. And I thought there was going to be a punchline. I really thought he was joking. He was serious. And, I really hope, this guy, he's got a jet, and he drives the same car as the Queen of England, and he's really smart, and he's very persuasive. He's got millions of people following him. I really hope it works out well for him, but I don't know if it will. There's also wolves in sheep's clothing, and the wolves in sheep's clothing are people who are trying to do deals just to make a fee, regardless of how it turns out for you as the investor. And I hope, again, I don't want to see you or me get burned by that. So let's talk about why I love self-storage. I spent about a lot of the year 2018 researching and starting to invest in self-storage. There's a lot of reasons to love it. Let me count the ways here. First of all, it's recession resistant. Think about it. If people are downsizing in a recession from, say, a 4,000 to a 2,000 square foot home, they're going to need a place to store their stuff. And self-storage is a place to store their stuff at a relatively low percentage of their income. Now, during boom times, people are shopping at Walmart or on Amazon, and they're buying more stuff, and they need a place to store their stuff. And I don't want to sound like that guy that says, I guarantee this works really well in all economies, but this has been an asset class that has worked really well in both types of economies. There's another thing I love, and that is the tenant switching costs are very high. Tenants are sticky, and I don't mean they wear Velcro suits, but these tenants are very likely to stay. Here's an example. If I'm charging you $1,000 a month to lease an apartment and I raise your rent 6%, you might leave for that $60 a month, especially when you plan to rent long term. But if you're a self-storage tenant and I raise your rent and you're paying $100 a month and I raise it 6%, you're probably not going to take a Saturday, rent a U-Haul, get your friends, pack up all your junk, treasures, and put it in a U-Haul and move it down the street to save $6 a month. You're probably not going to do that. You're probably just going to stay around, especially when you consider the fact that you only plan to be there a few more months anyway. So tenants usually don't leave. My favorite thing about self-storage is it's a large and fragmented industry. There are lots and lots of mom and pop operators, lots of people who don't know how to or care to maximize the value of their facility. They don't know how to do professional marketing. Heck, a lot of them don't even have websites. Their attitude is, if we build it, they will come. And come they did. All through the 80s, 90s, early 2000s, people filled up these storage facilities. Well, a lot of these are in the path of growth. And, there are as many self-storage facilities as McDonald's, Starbucks, and Subways combined, about 53,000 total. About 40,000 of these are mom and pops or independently operated, and they don't maximize income, which means they don't add the U-Haul. They don't bother to sell locks, boxes, scissors, tape. They don't maximize rent increases. They don't add late fees and admin charges. They don't really think through how to do the marketing well. They're just happy that it's 70 or 80 or even 100% full. And we can go in and acquire these facilities that are in the path of growth. And sometimes we can add a building and really increase income that way. Or sometimes we can add a lot of these things I mentioned in an earlier slide. So it is a great industry to work in, to buy from mom and pop. A lot of these mom and pops consider they're passive investors. They basically say, look, I've got a passive piece of real estate. I just collect mailbox money. And that's fine. They're making money doing it. But the question is this really a passive piece of real estate? Or is it more of a quasi retail business? And I'd say it's the latter. So if you can invest with an operator that sees it that way as a real retail business using real estate to leverage, that is a powerful way to make money in self-storage. I already mentioned there's a lot of opportunities for ancillary income like U-Haul, locks, boxes, etc. A lot of those are very, very low cost. It doesn't cost a lot to add U-Haul. It doesn't cost anything to change some of these policies and procedures, to charge late fees, insurance, etc. Now, I already mentioned the leverage effect, how you can take $1 increase income and turn it into something like $200 increase value, and then even multiply that by 2 or 3 times because of leverage. It's powerful. And so our plan with Wellings Capital is to find operators to invest in who know how to find a mom and pop and operate it really well, and then sell it to an institutional buyer on the other end. Now, by doing that, they're increasing the numerator. Remember, the value is the net operating income divided by the cap rate. They can increase the income by selling it to an institutional like a REIT. They can decrease the cap rate or compress it. And by doing that, they can actually make a significant profit for their investors. It's actually, every time I look through it, it's powerful. So,
hey, Paul,
yes.
We had a question early on, and since you went back to it there, Dan asks, when calculating the value, you do not take debt service into the equation, the mortgage. Do you also not count depreciation? And I think that's correct as well. So it's basically the gross income minus the expenses that equals the net income.
That's right. That's exactly right. That is the value formula. Now, those other things are important. And this webinar doesn't actually get into tax savings of commercial real estate, but the depreciation gives us very significant tax savings if you're, for the part of your money that's invested that's not in an IRA. And we're not going to get into that today unless you want to, but that's absolutely correct.
Yep. No, I don't think so. Let's stay on the top level stuff here. I think what you're doing is great.
Okay, great. Thanks for the question. And I didn't get that on my panel, Carl, so please interrupt me anytime you want to throw a question in because I'm not seeing them for some reason. This is a quick overview of the economic benefits of self-storage. We just went through most of these. I think we went through all of them, so let's move on. Why self-storage? Well, this is pretty powerful. Manufactured housing and self-storage are at the top level of the increased net operating income at each property. So any given property has, if you look from about 2000 on, you can see that manufactured housing, also known as mobile home parks, and self-storage have been the top two increases. Now that doesn't mean they'll continue to increase. In fact, you've got to be really careful, especially with self-storage, because it's becoming like apartments, largely overbuilt. And so you might wonder, well, wait a minute, I thought you just said it was great. It is great, but you've got to be selective. Of those 53,000 self-storage facilities in the US, a lot of those are in areas that are overbuilt. I went to Greenville, South Carolina yesterday, and there were like 29 self-storage facilities in a 5-mile radius. That's a potential overbuilt situation. Now they're building thousands of new homes in that same 5-mile radius, but some of those folks are going to get squeezed out, and it's really important that you do your own analysis and decide, whether the self-storage facility you want to invest in is in a great location. This is the REIT returns, and I don't put a lot of stock in this, but hey, the REIT returns for self-storage were by far the highest from 1994 to 2017, according to the National Association of REITs. Now, I mentioned earlier that it's a highly fragmented industry. The top 10 self-storage facility companies only make up 26% of the ownership in self-storage. And so this is why I call it the mom and pop effect. So 70 some percent, let's say 60 some percent, because some of those independent operators are still very good operators. So let's say 60% or so of the facilities out there are owned by small independent operators or mom and pops. And this is kind of what you can get out of there. I see a typo in there, little or no online presence, limited hours. Yesterday we got there and the hours were posted at the self-storage facility, but nobody was there. There's very little technology. I went to a self-storage facility in Raleigh, North Carolina, Carl, and they had no website. And this is still unbelievable to me. They wouldn't take credit cards. That's one of the huge benefits of self-storage, is that it just dings people's credit card once a month and they kind of forget about it. I met a guy who was a doctor. He said he invested in self-storage because he remembered that he'd been getting hit on his credit card or bank account, ACH. For 7 straight years, he'd almost forgotten about it. She wouldn't take credit cards. She said you had to come in and pay with cash or a check. So anyway, the mom and pop experience leads to a phenomenal potential in self-storage. Now, 93% of multifamily owners of apartment units over 50 are larger operators. They're multiple facility owners, but 63% of self-storage owners own only individual units. Okay, so as opposed to 7% in multifamily owning individual units, 7% above 50 units, 63% of self-storage reportedly are individual owners. So now I'm talking about increasing the numerator. I'm also talking about decreasing the denominator in that value formula. And so the way to do that is by aggregating, by franchising your operation, by aggregating a number of self-storage facilities, making them very similar, and then selling them to a REIT. And by doing that, the returns, the denominator, the cap rate, the capitalization rate can be massively compressed, which will allow a much higher ROI, for a return on equity, I should say. For example, if you buy at 7% cap rate and you sell at a 5.5% cap rate, that doesn't sound like a whole lot. It's 1.5%. But if you do the math, that's over a 20% appreciation to the asset value. 20% appreciation just by selling to the right buyer. But it's more than that, because 20% appreciation to the asset at a 60% loan to value ratio is a 50% appreciation to the equity. That's just by finding the right buyer. You can also increase the numerator. Like I said, I love commercial real estate. So we're going to move a little quicker here. It's 12:30. Why I love manufactured home communities. Now, even more than self-storage, they're recession resistant. They are steady in all cycles. It's the only asset class I know, Carl, that has a shrinking supply. There's less mobile home parks every year than there were the year before. I saw some stats for Austin and Orlando, and it's kind of shocking how quickly they're going away. But as we know from the news, there's an affordable housing crisis. There's an increased demand. So the demand and supply are moving in opposite directions. There's very high switching costs, much more than self-storage even. Imagine you're paying $300 a month for lot rent, and you get a $30 increase. You get mad at the owner and you say, I'm going to move. You got to spend about $5,000 to move your mobile home down the street. You're probably not going to do it. And you know that if you move down the street to save $30, you could get the lot increase there a year later. So the switching costs are really high, even more so for double wides. Mobile home parks are also mom and pop owners, very fragmented, even more than self-storage. There's very low maintenance and capital expenses. They're very predictable because basically you're leasing land with land improvements. By the way, somebody asked about depreciation earlier. 70% of a mobile home park can typically be depreciated. 30% is land, 35% is land improvements. That would be like utilities, sidewalks, parking lot stripes, shrubbery, etc. That can be depreciated 15-year straight line. And get this, 35% goodwill, which can also be depreciated 15-year straight line. Go figure. So it's great for depreciation, great for taxes if that's of concern to you, not to your really brilliant IRA investors. It's probably not. But there's less competition. There's a big stigma with mobile homes. And I've got a picture I'll show you later about that. But here's some quotes from some mobile home park investors. My favorite one is live where you want and invest where it makes sense. And that's from Robert Helms of the radio real estate guys radio show. Did you know that 10,000 people are turning 65 every day? 1 in 3 have zero savings for retirement. Nearly 6 in 10 has less than 10,000 saved, but a lot of them have equity in their home. And if they have equity in their home, they might be willing to trade that equity in to buy a mobile home park and trade their mortgage for a $300 or $350 lot rent, and they can live happily ever after. And a lot of those folks are doing that. So we've already seen this graph before. This graph, what you want to be on this graph, if you study that, is you want to be as high as possible, where you want your star as high as possible, and that is the average square feet on the right y-axis, and you want your bar from the bottom up as low as possible, which is your monthly cost on the left axis. And as you can see, manufactured homes have the highest ratio of square feet to cost. In fact, it's far, far better than apartments in the middle and single family homes on the right. And that's just common sense, right? So here's a comparison between 2-bedroom apartments and the cost of manufactured housing. This doesn't include the cost of the house, but sometimes mobile homes can be picked up used for $5,000 or $10,000. Sometimes you can just move in and pick them up from somebody who abandoned one, do some work on it. But the lot rent on the right compared to the apartment cost on the left, pretty powerful comparison. You're at a fraction of the cost of an apartment, and even probably less as compared to home ownership. So capital expenses as a percentage of revenue, as a multifamily owner, I can tell you that the capital expenses can be really high. Manufactured housing is very low because they're predictable. They're mainly land improvements. They're mainly utilities, sidewalks, parking lot stripes. That's pretty predictable. Self-storage is pretty good too. You can see it's 4.7%, manufactured housing 3.6, as compared to multifamily at 12, and the overall at about 8%. But the problem with mobile home parks, and you might be thinking this too, is there's a stigma. You probably don't live in a mobile home, and you probably don't even know anybody who has. You probably haven't. You probably lived in an apartment before. You've probably used self-storage or know somebody who does. You might not know anybody who lives in a mobile home. So there's a stigma. And if you look at the place on the left there, that's how I used to think of mobile home parks and mobile homes. And it's not a place I'd really be excited about investing, but the place on the right is actually more like what we're talking about, more like what we're investing in at Wellings Capital. So that stigma, again, I go back to the real estate guy's radio comment, and that is live where you want, invest where it makes sense. So this is another graph I found from Green Street Advisors. They're a really good commercial advisory firm. And they say manufactured homes have had by far the best expected buy and hold return. Self-storage has been tied for second with healthcare. So last year, like I mentioned, we, Wellings Capital, decided we didn't want to be operators anymore. We wanted to, like Warren Buffett, find great operators to invest with. And so we're investing with operators who have a great track record, who have, or investing versus speculating. They have the same character and ethics as we do. By the way, I'm saying all this to tell you that this is what I recommend you do if you decide to invest in self-storage or mobile home parks, or anything for that matter. We were looking for a diverse asset class that didn't lose money in all types of economies. We were looking for operator criteria, people who knew how to acquire right. You know, they say you make money when you buy. I say you make money when you buy, operate, and exit. So we're looking for people who can do all that. We're looking to diversify across geography and assets. We're looking for both appreciation and income. So when you invest in an asset in self-storage, mobile home parks, or multifamily, I recommend that you first make sure you get an operator that buys it right, or you buy it right. Make sure you get a professional operator who treats it like an active business versus a passive piece of real estate. Make sure that it's a company, or make sure if you do this, that you're raising your rates and managing your tenant mix. If I had time, I'd go into that. But basically, technology now allows us to manage our individual tenants, just like airlines manage individual seats. Now, you may hate that feeling of paying twice what the person next to you paid, but that's what happens in a really professionally run self-storage. We can actually drill down on the motivations behind every individual self-storage tenant, and we may be in a position where we can raise rates on one more than another. We want to improve marketing. We want to improve other income, add rentable units if possible. A lot of these facilities have acres of vacant land where they park RVs, or maybe just weeds are growing. If you can, add climate-controlled self-storage, especially if it's by the road, which a lot of the operators we invest with do this, it can be a very powerful opportunity to increase your income and magnify or really multiply your wealth. We talked about the impact on the income and value, and we're also looking for operators who can refinance and return money early on. Did you know Freddie Mac and Fannie Mae, in the first 5 years of the mobile home park, they are so bullish on it. The interest rates in some of these loans are still in the high threes now for mobile home parks. And you can actually refinance twice in the first 5 years with no penalty and no increased interest rate. And so if that guy who paved the acre of weeds, if he can refinance in, say, year 4 and give us back all of our principal, from that time on, we have an infinite return because there's no I in the ROI anymore. The denominator is gone. So the return on zero is now infinite. And that's the kind of things we are investing in. So as you look for an operator to invest in, and like I said, Carl, we're not actually operators anymore. We're actually investors. Our funds are passively investing with these operators. So we're looking for the same things many of you might be. We're looking for somebody with decades of experience who've lived and thrived through more than one recession, with an experienced internal team, track record of success, high ethics, high integrity, inside track on acquisitions, franchise-like operations, and exits to institutionals, or they're doing the refi and long-term hold, which is also a great strategy. You mentioned, Carl, that you're a buy and hold investor. You know, Warren Buffett said, and it's very famous, you probably already know this, but he said, my ideal holding time is forever. And a lot of the operators we're starting to invest with feel the same way. This is one of our operators. He's had assets in over 30 states, 175 plus assets, 25,000 units across the US. This operator invests in self-storage and manufactured home communities. So this is a recent investment we did in Lancaster, Ohio with that operator. It's a mobile home park, obviously. This is a ground up self-storage facility in Austin, Texas that was just opened last year. I'm sorry, I think that was actually in a suburb of Denver. This is a mobile home park somewhere, Minot, North Dakota. And here's a beautiful mobile home park, manufactured home community, excuse me, that is in Gillette, Wyoming. And this is the self-storage facility in Austin, Texas. So thanks. I wanted to thank you for joining us today. And if Carl said I could put my contact information up here. If you want to chat with me more about self-storage, manufactured homes, multifamily, just shoot the breeze, whatever. Would love to chat with you. We also have a mentoring program at Wellings Capital where we help people just get jump started in their real estate career. If you have any interest in that, you can contact me at this 800 number, this email address, or this website, wellingscapital.com. So I'm ready for questions, Carl.
Hey, thanks, Paul. I appreciate that. And one of the reasons I like for you to have this up is because people listening to this, as we'll have it posted, will be able to call you and not our office
Right.
for the answer. So thanks for providing that slide. I have a question here. Is it difficult to find raw land that is zoned for MHCs, and how many acres would it be reasonable number to construct a multi-home community?
Yeah, mobile home park. I hate to disappoint you, but I don't know of any mobile home parks that can be built in a place you'd want to build them. Okay. So I chose, my family 21 years ago, we sold our company in Detroit, chose to move to the Blue Ridge Mountains of Virginia. So we're between we're between Roanoke and Lynchburg, Virginia. You could probably find some raw land out here in a rural area to construct a mobile home park, but who wants to? I mean, the demographics aren't great, and I wouldn't recommend that you do that. But could you find some raw land to do that near a really booming metropolis? Probably not. So that's why, you know, that we have a situation where the supply is actually shrinking, where municipalities, as they expand, are trying to drive out mobile home parks. And there's very few being built, if any, in areas where you could. So sorry to disappoint you. I don't think that that's a real viable thing to do. If you can figure it out, please call me. I'd be interested.
All right. Hey, appreciate that answer. So here's another one. Buy and hold question. You know, storage and mobile home parks. You said you look for operators that will buy them, fix them up, improve them, get the cash flow up, get the equity up, and then sell them. And this was questioned earlier, but so are you looking to sell them for the most part, or when does it make sense to sell them versus buy and hold them? I think is what they're asking.
No, that makes sense. I really want to give a thoughtful answer, Carl. There are a lot of, especially in the path of growth, like I'm thinking of some properties near Marietta, Georgia, which was a sleepy town outside of Atlanta that's now a booming suburb. There are REITs moving into that area who would love to acquire a professionally run franchise-like operation. And so when it's in the path of growth, and when there's a REIT swooping in, sometimes you just can't say no. Here's a quick example. One of the companies we invested with has an asset in Fort Myers, Florida, and then they have another one that they've similarly improved in another city near Fort Myers. And a REIT just came in and offered 4.4% cap rate if they would sell both of those. Well, that's going to be pretty hard for this guy to turn down. By the way, this operator, I didn't invest in those. It was before my time. This operator has done 19 that he took full cycle from acquiring from a mom and pop, improving, and then selling to a REIT or a similar institutional buyer. His average ROI, and this is documented historically, so I can say it, is 70.1% annual ROI to his investors. Will he be able to do that this year and in the future? I highly doubt it, because we've had a huge rising tide in self-storage and other commercial real estate for the last 11 years since the bottom of the recession in 2008. But will he still be able to provide great returns? I'm guessing he can, and that's why we're investing with them. But when you can buy at a 7% cap rate, dramatically improve the income, and then sell at a 4.4% cap rate, my goodness, it probably makes sense to sell. If you can't sell at that good of a cap rate, that low, that compressed of a cap rate, it might make sense to hold. Here's another very quick example. A friend of mine renovated a super Kmart. He had $7.5 million in it. He just got it. That was $2.5 million cash and $5 million debt. He just got an offer from a REIT to sell it for, you ready? $25 million 3 years later. He's only 40% leased up because he's only had it open for about a year. He turned it down. He's a buy and hold guy like you, Carl, and he wanted to hold on to it. He didn't care about the 900% return. So I just really confused the audience by saying, I don't know when it makes sense to sell and buy. But Carl, maybe you can help me here. Honestly, I just think sometimes it depends on the operator. We are choosing to let go of control at Wellings Capital and trust these operators to make the best decision.
Yeah, I don't, I'm still struggling with when to sell and when to buy. I know I should have sold in 2008 and 9. That sounded really tasty.
That was my superfood smoothie.
Good. Here's another question, kind of feeding off of the last one. There is, how many acres on average is your mobile home parks? And if you don't know that, can you tell us your smallest and the biggest that you invest in by acre?
Yeah, so the smallest we might, acreage.
Or
No, I don't know. I'm so sorry, I don't know. I would say about 100 units would be the smallest we would do, and about 600 lots would be the largest we would probably do.
All right, that seems to answer that, but you don't know what acreage, and I guess it depends on how many lots they allow you to have and the different.
Yeah, this is a decision we made at Wellings Capital, and that is we decided to trust these operators to make these decisions. And so by taking our hands off and trusting these people who've been doing it for 20, 30, 40 years, they're making those type of decisions. And the density is very different at different locations.
Okay, here's another question. At the beginning, you said that the multifamily housing, the apartment complexes, could be overheated and are hard to find. how
Yeah.
about the self-storage and mobile home parks? Are they still overheated? I got a mixed message in your presentation. Are they
Yeah.
hard to find?
Yeah, they're overheated, they're hard to find, but remember my slide where I said 93% of multifamily are owned by multiple facility owners, in other words, larger owners. They're not fragmented. Multifamily has been thoroughly picked over, and it's very, very hard to find a great deal in multifamily. Self-storage and mobile home parks, so fragmented, and they're newer to the game of larger commercial investing. So there's still opportunities. Hard to find? Yeah. Overpriced? Absolutely. But there are easier to find deals with a whole lot of meat on the bones because of all the mom and pop operators in self-storage and mobile home parks.
Here's another one. Does your book talk about the mobile home parks and self-storage, or just multiple family?
Yeah, so my book called The Perfect Investment is all about apartments. I mentioned self-storage in one whole sentence. So no, it's a primer on commercial real estate investing in general, but it's all about apartments. I'm actually writing a book on self-storage that should be out in 2019.
Okay, great. Maybe you can bring a copy to the summit
That's a great idea.
for those, if you can get it done by then.
I
All right,
will. I'll have it done.
Paul, I want to thank you for giving us your time today. And again, if people want to contact you, they can email you at info@wellingscapital.com.
That's right.
Or they can call 1-800-844-2188.
Right.
If you would give us some parting words, and we'll sign off and get back to work.
Well, as I've said on other webinars, Carl, my parting words would be this. When I became an investor in the year 1998, I had more money than sense. I was in my mid-30s, and I didn't care about retirement. I didn't care about setting up my IRA. I didn't care about all that stuff. I cared about making a lot more money. And so I did not become an investor. I told people I was an investor. I was actually a speculator, because investing is when your principal is generally safe and you have a chance to make a return. Speculating or gambling is when your principal is not at all safe and you have a chance to make a return. It's fine to do either, but you need to know the difference. And if you're speculating when you think you're investing and you're plowing all your money into that, you could lose it all. And if you keep playing double or nothing with your investment proceeds, you're going to end up on nothing at some point, and you'll have nothing to double later. So my parting advice would be, make sure that you're investing, or at least if you're speculating, do that with a small part of your proceeds and invest safely with most of it. That's the advice of people like Warren Buffett, Howard Marks. I wish I'd have known about them 21 years ago when I flushed a lot of my proceeds down the toilet. And you can learn more about that at my podcast, How to Lose Money. But I would, just recommend that people really take care to be careful with their investment dollars and invest for the future. Invest using an IRA anytime you can.
Thanks a lot, Paul, again for your time, and thanks to everybody who attended today's webinar. We look forward to hearing from you next month and on the subjects coming up in your series. And with that, we'll conclude today.
Okay, thanks, Carl. Thanks, everybody.